The P2P or peer-to-peer lending industry in India is kinda dying. Well, what is it? It's a mechanism of connecting borrowers and lenders directly without them having to depend on a bank or any other financial institution. How does it work? Usually through a website like Faircent or Finzi or Credmint or Lendane Club. These are websites that connect, as I said, borrowers and lenders. So, you visit the P2P platform and fill an online application. The platform reads through your application, assesses your credit and risk rating, and assigns you an interest rate based on your credit worthiness. Once the application is approved, the borrower receives loan options from investors on the other side of the platform based on their credit rating and the assigned interest rates. You get the loan amount and your repayment cycle starts. The investor, of course, gets some interest, and the platform, of course, also charges a fee from you and the lender. Now, this would seem like a great step towards expanding financial inclusion, right? It's still a fledgling industry, of course, just 26 recognized players by the RBI, many of them inactive, and 10,000 crore rupees of assets under management or AUM. However, there are risks, higher risks than usual related to liquidity, defaults, and of exploiting regulatory loopholes. Which is why the RBI has been taking a very hard look at this sector for the last few years. The first set of RBI mandates asking companies to bring about changes in business came in 2017. Some of the companies did adhere to the new norms and many did not. The RBI was not happy. Finally, on August 16th, it slapped an order so terse that is now being looked at a near death knell for the sector. So what is the RBI mandate and what lies ahead for P2P lending in India? Listen on, it's Thursday the 5th of September. From the Economic Times, I'm your host Anirban Chaudhary. This is the Morning Brief. First up, my colleague and ET's fintech expert, Pratik Bhakta. Hi Pratik, very warm welcome again to the Morning Brief. Always a pleasure to have you with us.
Thank you, Anirban. Pleasure's mine.
So let's start with what happened on August 16th that has shaken the very foundations of the so-called P2P lending industry.
Yeah, so on August 16, the RBI published a review of the master direction to the P2P industry. A master direction is like an omnibus, which any regulated sector needs to follow. Mind you, the first master direction to the industry was released in 2017 and jumped to 2024, August 16, the RBI issued a review. So this kind of shook the industry from its core because a lot of its basic functional principles got impacted by the regulatory update. The RBI made some things very, very clear that you can't do this, you can't do that. And one of those things was you cannot touch the escrow account. And next, it said that whatever funds move into the escrow account, it needs to be returned to the borrower or returned to the lender within 1 day. So this kind of shook the entire process in which P2P startups function, kind of disrupted their existing business very, very badly.
Which brings me to the question, why did the RBI feel the need to do so? Or rather, what was it about the industry that irked the central bank so much?
So for this, we have to understand that the RBI wanted to regulate the P2P sector in a light touch manner. So light touch manner regulations mean that there is ample scope for a startup to innovate, grow, and kind of work on their products in their own manner. And so the sector did. Multiple players within the sector interpreted guidelines in their own manner, entered into secondary market transactions. They did partnerships with large consumer-facing applications through which they sourced borrowers and lenders. They also indirectly gave some forms of guarantees to the investors saying that you will get this much of return from the P2P platform. Mind you, a lot of these were red flags which were mentioned in the first master direction by the RBI. But somehow the industry thought that they could push the boundaries, or maybe they interpreted the rules in their own way. But over the years, when the RBI looked into the business models of these players, audited their accounts, looked into their process flows, the regulator was extremely irked. But somehow the industry was not able to course correct. So finally, that brought the RBI to a position where they had to take this drastic measure.
Right. You said they weren't able to course correct to the extent that would sort of make the RBI satisfied with what they were doing. But you've been covering this for a while now, and you've sort of written a lot of stories in the last few months, which seem to point out that they did make efforts at course correction, right?
They did, but I think it was either too late or it was not enough. For instance, a lot of these partnership businesses, which were with large consumer facing applications like Bharat Pay, Cred, and many others, a few of the P2P startups went slow on these partnerships. They even abandoned few of the partnerships. And this talking about things that have happened over the last 1 year. Then the P2P industry as a whole came together and kind of decided to stop all kinds of liquid products, that is instant withdrawal products, because P2P as a policy, you're not supposed to be able to withdraw money instantaneously. You need to play out the tenure of the loan. So they had done all these course corrections, but I think it was either too late, and second, the RBI was very concerned about more systemic risks that were building up in the sector, which brought the regulator to such a harsh stand as it stands now.
So, Pratik, this brings us to what lies ahead for the P2P lending industry now. Is it end game for them, or does it mean a decisive transformation of their business models? For that, you had a great conversation with Mukesh Bubna, founder of one of the prominent P2P lending firms in India, Monexo. Let's go over to that conversation.
So thank you, Mukesh. Thank you for taking time out today and coming on our podcast. Why do you think the RBI came out with such stringent guidelines for the P2P sector?
Thank you, Pratik, for having me on the show. Again, reading a regulator's mind is very difficult, so I'll only be hazarding a guess. However, I have a viewpoint which I would leave with the listeners here, that, and this is purely my personal view, a regulator has to look at both sides of the coin, protecting the consumer and two, enabling growth of the regulated entities which they regulate. This change, which has come on August 16th on the master directions for P2P lending, has swung the pendulum mostly towards protecting the consumers, and that should be rightfully done. But it has left the industry suddenly without wind in the sail.
So while that obviously is the direct impact of the guidelines, but why? Like, typically we've seen the regulator being stringent, but at the same time, it has always brought the industry, especially the fintech industry, it has encouraged the industry, if I may say so. But why is the P2P industry, at such a negative form vis-a-vis the regulator?
If you look at the first page of the guideline, it really talks about violations, like players were providing margin of safety, they were selling this term-based product, there were places where they were giving daily interest out to the investors or lenders. There were a secondary market operation where they were taking bad loans from a customer and giving it to B customer. And I think those were clear violations in the industry by the players which did that. And I suppose that sometimes for the RBI is saying, looks like the whole industry is bad, so let's pause them for a while, right? So I'll give one example where I'm also impacted. I did run auto invest on my platform. I always asked my lender, how much amount do you want to give to each borrower? And what kind of loans do you want to participate in? I had conservative risk, moderate risk, and high risk. While the industry players, some of them would not even ask any questions and they would run the whole program themselves. In the industry, what was happening was Mr. A had 100 loans, 10 loans were bad. They were transferred to Mr. B. What that gave Mr. A a feeling that these loans were, or these platforms had no risk. So That is why somewhere this 7, 8 year old industry missed out having a constant dialogue with RBI. I wish on the hindsight there were more collaboration between the regulator and the industry proactively rather than reactively now.
Right. And I think very valid points, Mukesh. And thanks for explaining it so nicely as well. If I ask you two or three most contentious points for the industry vis a vis the August 16 regulatory update, what would those be?
I can go on and on for that, but one word which or two words which describes this is now the whole consumer experience of participating as a lender on P2P lending is broken. It's completely broken. I'll explain one by one. Today, let's assume, Pratik, you want to become a lender, you register, there's no challenge with that. And let's assume you want to bring 50 lakh, which is the cap for lending. Even prior to this, you required a CA certificate. You gave us a CA certificate and your account was set up. Now, let's assume you want to diversify across 5,000 borrowers. Now, just imagine now Pratik has to sit down and choose 5,000 loans. Do you think any HNI will do that? He has no time for doing this. Now, if for whatever reason we are unable to, as a platform, have 5,000 loans at 1 minute or in T plus 1 day, and we were only able to invest 8 lakh rupees of yours, we'll have to send you 42 lakh rupee back, right? You'll say, what did you do? Why did you take my 50 lakh and not use it? Now, for a moment, let's assume you were able to give 50 lakh out. Now, that means you have 5,000 borrowers in your portfolio, which is very good. Now, what will happen next month? The platform will collect 5,000 lenders' money. They don't come on the same day, they'll come throughout the month. Now, just imagine some days we'll even collect from one of your investment 100 rupees, or in some investment, we'll only collect 10 rupees for you. We are supposed to send that back on T plus 1. You will have 30 or 20 transactions on your credit side. Your bank account on the credit side will now look like a UPI, the 20 rupee, 30 rupee debit which you do, right? And just imagine what the platform has to do. Platform will have to spend money for sending you 100 rupees, 3 rupees. So this will become a huge hue and cry. Beyond this, Pratik has given 50 lakh. He wants to use this capital over a period of time. He does not want 20,000 rupee to come this month, 30,000 rupee to come next month. His capital will be broken. His reconciliation will become very huge. So in a way, this will become a platform for people who want to just try out with 10,000 rupee, 15,000 rupee and see it. Borrowers will run away because they have so many options available that they'll say, you guys are taking too long to disburse my loan. I would rather move to a bank or an NBFC to do so. So this whole customer experience, both for a borrower or for the lender or for the platform to do business, is broken now.
Got it. And then it brings us to the straight question. Do you think the commercial viability of the P2P startups is a big question mark now?
I wouldn't say it is unviable. I'm quite sure entrepreneurs will find solution for it. But today, as it stands, it looks difficult. The technology cost will increase. The cost of fund transfers will increase. The borrowers who look for a quick fund transfer and want money quickly, they will not get it. So they will abandon the transaction. So the cost of borrower acquisition will also increase.
So, as a P2P industry and as a P2P startup, what is the next line of action for you guys?
I hope we can go back to the regulator and have a objective discussion with these changes, what it means to the consumer, and as well as explain to RBI that how this will be a challenging task for any P2P lending platform to grow to a meaningful size to make a difference. Right? Even MSMEs, like I have certain borrowers who are MSMEs, they want to get a 40,000 rupee loan or 20,000 rupee loan, which banks will not do, even small and bigger NBFCs will not do. And they want to buy a product. And that's a window of 6 to 8 hours. They will not come to us anymore because I can't serve him.
I think there's one more interesting point that that I would like you to talk about. The guidelines came in 2017. We are in
Yeah.
2024. 7 years have passed.
Yeah.
The question that is often being raised is, why did the regulator react so late?
We have seen RBI being proactive. If somebody has to look at what is happening in India with UPI and yesterday's announcement with unified lending platforms, they are very proactive measures. Yes, some of these violations or misinterpretation were going on for quite some time, and it was visible. It was visible to the consumer, it was visible to the industry players. I'm not sure if RBI knew it end to end, but there was enough to step in faster and have a more dialogue. I'm a big believer dialogue can solve a lot of things.
Great. Yeah, I think very valid observations and very interesting observations. P2P as a whole, we are seeing that the regulators are cracking down. We've seen that in China, and now there's stuff happening in Indonesia as well, and now it's happening in India. Is it something that regulators worldwide are very concerned about and they don't want this to grow?
See, P2P industry is not new. It started in 2004. In UK, it became 2005. In US, it grew handsomely and it has evolved. The word P2P, peer-to-peer lending marketplace is now P2P lending platforms is now called P2P lending marketplace, where this 50 lakh rupee limits are not there. Banks are participating onto it. Mutual funds are participating into it. Government themselves are participating onto it to promote credit enablement in certain segments. So I think we have to look forward rather than always look backward. And in China, it bloomed beautifully, same way it bloomed in India, but exactly the same problem happened there. The regulators were not engaged, the players were not engaged with the regulators, they were working in silo, and the platforms became exactly like a bank. They started taking deposits. And that's when the regulator felt completely uncomfortable. And exactly what India did, China also did. And they did it in 2016 or 17.
Right. I think, Mukesh, I've asked you the questions that I had in mind. Thank you very much.
No, thank you for the questions. I have put in 8 years in this business, walked the title rope of being a platform. It's not easy. I believe this industry needs all the three legs to stand: regulator, consumer, and the platforms to work ethically. And it can solve a lot of problems of credit inclusion in India, as well as people all just today running towards mutual funds. They will have one more asset class which they can look up to. But we need to work together.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by me and sound designed by Rajas Naik. The Morning Brief drops every Tuesday, Thursday, and Friday on a listening platform of your choice. Also, listen to 7 at 7. That's 7 a short, quick financial news capsule to get you started for the day. Thank you and have a good week.